Hi everyone, I'm Kunal Sodhani from Global Trading Center, Shinhan Bank India, and we are here to decode the domestic trends, understand the global sentiments, and break them down into our analysis on several currency pairs. So first, talking about the domestic factor, let's talk about the trade deficit number. The trade deficit number for the month of February came in at around $18.71 billion versus the last number at $17.49 billion. That was for the month of January. Now yes, we have already seen the trade deficit getting widened. Gold imports have gone higher towards around $60 billion from roughly $54 billion for the last month, and exports have also gone higher to the tune of $41 billion from around $37 billion. So marginally, yes, exports have risen. The Red Sea crisis still remains a concern when it comes to exports, but if we compare it with the last year, we have still outperformed in terms of our export numbers. Overall, if we talk about April to January 2024 number, it has come around $72 billion versus $116 billion as compared to the same period last year. So definitely it has narrowed in terms of the overall number. What we foresee for the coming quarters and the coming months, we foresee the trade deficit numbers to be in the range of $20 to $25 billion. And if we break down into the current account deficit numbers, we eye for Q3 to around maybe 2.5% for Q3 of 24. And 1.7% of GDP for the Q4 2024. So that's about the current account deficit number. If we break down again into the balance of payments, the balance of payments anticipated for FY24 is a surplus of around $45 billion. And for FY25, we are anticipating a surplus of around $26 billion. So this was broadly understanding the trade deficit numbers and our anticipation for the future trajectory. Also, it's important to understand the inflation and the growth. So talking about the CPI number came in at 5.09% versus 5.10% for the month of January. Now it has been stagnant, but overall if we talk about it is still within the tolerance level of RBI, that is 2 to 6%. But another factor to consider is this is the 53rd consecutive month that the headline inflation number has been still above the median target level of 4%. If we again break down this into food inflation, which have been sticky, that number has come in around 8.66% versus 8.3%, so that number is higher. But on the other hand, the core inflation number is ticking down and it has come to 3.3% versus 3.6%. So this is the lowest number which we have seen since 2012. Effectively, if break down again the food inflation, the vegetable inflation is more sticky because year on year basis there is a 30% raise in terms of the inflationary pressure when it comes to vegetable. Again, there were two policy announcements, one with the petrol diesel prices coming off by 2 rupees. So that has been, I think, a change after 2 years we have seen. Plus PM Modi announcing the cylinder cut or the price by around 100 rupees per cylinder for the cooking gas, to release some burden from the households. Now these two factors contribute towards 15 to 25 basis point reduction in the CPI number. So we foresee the CPI number to come sub 5% in the coming numbers. If we talk about the growth numbers, the growth number came at for Q3 24, it came at around 8.4%. But there is one thing to understand here is the GVA and GDP. There are two different things. So GVA is the gross value added, which excludes the indirect taxes and subsidies. Once we exclude these two components, the GVA number comes at 6.5%, which is still lower as compared to the last number. Now, why this is important? Because the difference between the GDP and the GVA number used to be around 20 to 30 basis point, which has now widened to 190 basis point. So irrespective, we are seeing a higher GDP number broadly, but GVA number is to be considered very closely. As per the RBI bulletin recently, we have seen that India still continues to sustain at around 8% plus levels in terms of the growth numbers. Now let's move more towards the dollar rupee pair, because flows is something which is very important to consider. The FII or FDI flows are the two important flows. One is sticky and the hot money, and one is a long-term sustainable money, which is the FDI number. So first, talking about the FPI number, the last year 2023 we have seen the highest ever inflows of 1.71 lakh crores. This year for 2024, that is Jan till March, we have seen numbers of equity around 16,000 crores and debt to be around 53,000 crores of inflows. And if we also add the hybrid funds, the total number of inflows from Jan till March is around 75,000 crores. So it's a decent inflows which we have seen from the FPI perspective on both debt and equity front. But if we again break down into FDI, the FDI number has dropped by 38%. Now, when this is dropped by 38%, the number comes to $15 billion from $25 billion, which was last year. Ease of doing business and some other factors still contribute to this drop as major factors. Also, some important flows to be understood in this episode is the bond flows. The bond flows have been quite attractive and we have seen 53,000 crores of inflows already. Now, JP Morgan flows will start coming in from June 2024 to January 2025 incrementally, which we see that they will entitled to get inflows to our country to the tune of around $25 billion. Recently, Bloomberg Index has also come and included and are of the opinion that they will include Indian bonds into their global Bloomberg EM indexes, where again this will start from January 2025, breaking down into 10 months till October 2025, and this will also be incrementally with 10% each, but they will attract inflows of around $5 billion. So net from the bond perspective, around $30 billion of inflows can be expected, which can be supportive to the rupee. Though the markets are forward looking and obviously discounts that in the price to some extent. Again, let's move, when these inflows are there, FX reserves are also rising on the right side. So the current FX reserves currently stand around $636 billion, near the highs of $645 billion, which was seen in October 2021. The lows from where it has bounced is very important to understand, because in October 2022, after making the highs of 645, it went as low as $525 billion. From there, that has bounced towards $636 billion, so more than $100 billion bounce in FX reserve. Now, it has been a contribution by FCA, SDRs, and the gold, all three parameters rising and contributing to the rise of the FX reserve at large. RBI intervention was one of the major reasons. The spot purchases also contributed to this rise. So all the inflows which we are seeing in terms of equity and debt have been somewhere taken care by the RBI in terms of any kind of uncertainties when it comes to flows or any kind of uncertainties when it comes to import cover. We are protected at any given point in time. Now, if you also see the RBI bulletin for the forwards report, net forward outstanding as on Jan 31st, 2024 is around $9.97 billion. Also, if we break this down to the gross purchases and gross sales, so for the FX gross purchases for the month of January had been around $10.45 billion, which was around $31 billion last time. And if we also talk about the FX sales, that is for the month of January, it's around $8.45 billion, which was around $29 billion in the month of December. So net, there's still purchases of RBI to the tune of $1.95 billion. So it's an important element to consider, where RBI has been active from both the angles, where they have been protecting the range closely. So we have seen levels dropping to 80 to 65 and also levels as high as even 83.30. So that's the flows perspective and the FX reserves from the domestic perspective. Important aspect, another thing is elections. So the Election Commission has already announced the date. Polling dates are from April 19 to June 1st, and the results will be announced on June 4th. Last elections, I recall in 2019, BJP had secured victory with 303 seats. The anticipation is around 370 plus seats as per the market sentiments. This is the third consecutive victory in case if they are able to sail through in these elections also. So this election creates a lot of sentimental benefit and sentimental and fiscal affairs when it comes to the FPI and FDI money as well. So that's the perspective from the domestic side. So let's now move toward the global factors. Talking about the US Fed, we had the FOMC policy for the month of March, where we saw no change as expected. So the rates are 5.25% to 5.5% as for the fifth consecutive policy for the FOMC. Now, two important factors to consider. One is the dot plots. The dot plots for the year 2024 continues to see 3 rate cuts. For 2025, it has lowered down its rate cuts from 4 to 3. And for 2026, again 3 rate cuts are observed in the dot plot patterns. Second important factor is the growth. The growth revisions have been done from 1.4% to 2.1%, while also one more revision has been done in terms of the core inflation number from 2.4% to 2.6%. Now, Powell has been very clear in his speech and in his testimony also that they will be data dependent, inflation still remains sticky and that will remain a concern. So one or two hot data points or one or two cooling off of CPI numbers may not determine that. Also, in the press conference, they have clearly stated that they don't want to create any uncertainties with respect to going too soon for rate cuts and then again realizing or stopping in between. So they want a clarity and then they want to move ahead, which was very clear. If we talk about the dollar index from here, we see dollar index having a broader range of 180 to 104.85, where 104.85 acts as a very crucial resistance. 7 times from those levels it has reversed, but in case if we are able to breach those levels, then 105.80 is the next resistance level. For 10-year US Treasury yields, as we see dovish guidance coming into picture, we see it to move left with time, but broader range is 3.9%, while the higher side remains 4.45%. Let's also talk about the Brent crude prices, as it is very important when we talk about the dollar rupee pair. The Brent crude prices currently hovering around $85 to $87 per barrel. We see this range between $77 and $94 per barrel. We cannot ignore the Red Sea and the Middle East crisis, because once it flares up, it can have its own crucial impact on the Brent crude prices as well. Crude oil inventory data also are quite fluctuating at times, which also needs to be under-tagged. If we break down into major economies like the European Central Bank or the Bank of England, so let's talk about the European Central Bank first. The policy figures are further expected to follow Fed, though there have been some dovish comments recently starting being added by Christine Lagarde and the other members of them, but still at this point in time our personal anticipation remains that after Fed only they may start cutting their interest rates. So probably June month is what we are eyeing from ECB as well. So the broader range for euro dollar pair is 1.0580 to 1.1120. Now let's move on to the Bank of England. So Bank of England have a split of members who are hawkish as well as are dovish. So there remains a lack of clarity when it comes to interest rates. But as we discussed, once the major economy like Fed starts taking decisions, others in the historical terms have also started following, and we anticipate the same for Bank of England also, where we feel that August could be the month where they will start cutting rates, not even June. If we are talking about all the policy members, let's not miss about RBI, because in terms of the RBI trajectory also, we see repo not moving below 6% for this year. So maximum cuts we anticipate is maybe 2 rate cuts, and we anticipate the first cut to be in the month of August, not before that. So monsoons will also be important criteria when it comes to rate trajectory apart from the global sentiments. Now let's move on to the Bank of Japan. The Bank of Japan recently have gone through the negative interest rates and now have come to a range of 0 to 0.1% from the negative 0.1%. Initially, they were in the negative territory because they wanted to push consumers and businesses to spend more in order to boost the economic growth. But now, the wages have started growing higher. The corporates have started delivering more wage hikes to the workers, which in turn tells the Bank of Japan that yes, it's time to move towards the inflation trajectory, and now they are targeting 2% as an inflation goal from the growth figures. So the USD JPY pair, we anticipate 143.30 to act as a support, while 154 to act as a resistance. Now let's talk about the dollar rupee pair, where we all are anticipating this broader consolidation to continue or not. Well, 80 to 65 for us acts as a very important support. We have recently seen those lows and we have seen a bounce above 83 levels, while on the right side 83.35 acts as an important resistance, which is the near all-time highs. Now what is our suggestion when it comes to an importer as an exporter? For an importer, we see first the forward premiums to be an important consideration, because with time we see the forward premiums rising from here. 1 year forward premiums are currently trading at 1.65%. We see it drifting towards 2% with time, because we see the interest rate differential may not remain as constant as they are now. It's about who cuts faster and who is remaining constant. So we feel RBI may remain stagnant and Fed with time may start cutting rates comparatively faster, which pushes the interest rate differential higher. So for importers, the market has been kind enough that it has been giving opportunities on both the sides. We have seen levels below 83, so 82.65 to 82.80 is a very good zone for importers to hedge 40% of the exposure with fighting and getting their lower forward premiums into place. So for the near 3 months, they can be covered near 83 levels itself. For an exporter, we suggest that we are seeing levels again above 83.20. We should hedge 40% of exposure with a mental stop of 80 to 65 and 80 to 80 band, where if we are able to drift again to those levels, at least we are hedged to 40% of our exposure, and remaining 30% we can hedge if it moves below 82.80 and 82.65 band. Rest, if it is moving higher up, we would recommend to stay open for some more time and evaluate once again that if we can hedge around 83.60 levels for another 30%. So for both importers and exporters, our suggestion remains to hedge 70% at around the consolidated band, and either of the spikes only play around at 30% when it is either given to the market or in case if we decide to hedge further our exposure if it is in our favor. So that's all from the dollar rupee perspective. I am your host Kunal Sodhani, and it has been always a pleasure meeting you all and suggesting our views to the audiences at large. Hope you find our analysis valuable. Look forward to come back in the next quarter. Thank you so much everyone for your time. For any feedback, suggestion or any queries, you can get in touch on the email ID, that is gtcindia@shinhan.com. Thank you.